Using ETF SCHD, how long would it take me to turn $10,000 into $100,000? Because I follow the stock market, I tend to see a lot of information floating around about the Schwab US Dividend Equity ETF, or Exchange Traded Fund. If you're not familiar with an Exchange Traded Fund, an ETF is a collection or a basket of different investments, like stocks, bonds, or commodities. So instead of buying individual stocks or bonds, people can just buy shares of an ETF or an exchange traded fund. Think of it like this. Imagine you're growing up and you and your friends wanted to buy a bunch of different toys. But each toy costs a lot of money. So instead of each of you just buying one single toy, you pool all of your money together and you buy a big box of toys that all of you can share. That big box is like an ETF. The great thing about ETFs is that they give you a way to invest in a lot of different things at the same time without needing a lot of money. For example, if you wanted to buy shares of a popular technology company, it might cost you a lot of money. But with an ETF that includes that company, you can buy a small piece of the technology company along with other companies, and you typically don't need as much money to get started. Another cool thing about ETFs is that they can be bought and sold on the stock exchanges, just like individual stocks. So if you wanted to sell your shares of an ETF, you could do that easily, just as if you were selling regular shares. It's like trading toys with your friends. You can give away a toy that you don't want to play with anymore and get something else in return. Now, ETFs are managed by professionals, and they decide which investment should be in the ETF and how much of the investment should be included. They try to create a mix of investments that will do well over time. So when you buy shares of an ETF, you're trusting these professionals to make good decisions for you. So in simple terms, an ETF is like a big box of investments that you can buy a share of, allowing you to invest in many things at once without needing a lot of money. It's a way to own a small piece of many companies or other assets, and you can buy and sell those shares on a stock exchange. So from Yahoo Finance, let's go ahead and take a look and see how the Schwab US Dividend Equity ETF, stock symbol SCHD, finished out today. So we can see at the market close, the share price was $70.17. This ETF has net assets in excess of $46 billion and an average share trading volume of 3.4 million shares. So there's plenty of liquidity here. And it has an annual dividend yield of 3.64%. Another thing to note is that the expense ratio is 0.06%. This is a really low expense ratio, and it's used to pay the fees that manage this ETF. So at 0.06%, that's $6 for every $10,000 invested in this particular ETF. Drilling down and checking the performance of this particular ETF, we can see that it has a 10-year compound annual growth rate of 10.83%. Next, let's take a look at the 10-year dividend growth rate. This is the actual amount that the dividend will increase over time. We can see that for the past 3 years, the dividend growth rate is 14.05%. And for the last 5 years, the dividend growth rate is 12.24%. And lastly, the 10-year dividend growth rate is 11.35%. We'll use that as part of our calculations. Now that we've done some research on this ETF SCHD, let's go ahead and plug it into the dividend calculator to see some of the results. So first I'll enter the ticker symbol SCHD, and we can see it's the Schwab US Dividend Equity ETF. We know that the share price closed out at $70.17, and we want to be able to use our $10,000 to buy as many shares as possible. So in this case, we're going to be buying 142 shares. So our total investment amount from that $10,000 is $9,964.14. Now the expected dividend yield for this ETF that we saw is 3.64%. So let's go ahead and plug that in. And we know that the dividends are paid on a quarterly basis. In this example, we're not going to be making any additional contributions throughout the year, so we'll leave this at 0. When we looked up the expected annual dividend increase, we saw that it's 11.35%, and the expected annual share price increase is 10.83%. Now let's go ahead and calculate the returns so we can determine how long it would take to reach a minimum of $100,000, or in other words, 10 times our money. And here we could see that after 23 years, our ending balance would be $106,061. I went ahead and created a simple table so that we can keep track of the numbers that we're talking about. Here we can see the share price is $70.17. I purchased 142 shares, giving me a total investment amount of $9,964.14. So just under $10,000. Now the expense ratio is 0.06%. Remember, that's the money that's being paid, or the fee that I have to pay to the management team of the ETF. Now this ETF pays an annual dividend yield of 3.64%. And they use a quarterly distribution. So every 3 months, I would receive the dividend payment. Now, for this specific case, I'm not contributing any money. So you can see the zero contribution annually. And the 10-year compound annual growth rate of the ETF is 10.83%. So that's the amount that the price of the ETF has been shown to increase over time. And it's averaging 10.83%. And the dividend payment itself, so going back to that 3.64%, that has been increasing over time as well. And over the past 10 years, this has averaged out to be 11.35%. So in this case, I'm not taking advantage of the dividend reinvestment plan. And we can see that after 23 years, my ending balance would be $106,061. DRIP dividend reinvestment. We haven't taken a look at that yet, but let me show you how this magic works. DRIP, also known as the Dividend Reinvestment Plan, is an investment strategy that allows shareholders to automatically reinvest their cash dividends back into their original stock investment. So instead of receiving the dividends as cash payouts, the dividends are used to buy more shares, thereby increasing the investor's ownership. This just means you become a little bit more of an owner every time a dividend is paid out. So now that we know what DRIP is, our dividend reinvestment plan, let's go ahead and use those same numbers, but this time we're going to go ahead and activate DRIP to see how that will have an effect on the end result. And now we can see that after 14 years, our ending balance would be $126,971. In the second scenario, I kept everything the same except for this one item, the dividend reinvestment plan. I decided to enable that and take advantage of having the dividend payouts actually go towards buying more shares. And take a look at the difference. I'm able to reach $100,000 or more in only 14 years. So by enabling the dividend reinvestment plan, or DRIP, I'm able to save 9 years and reach the $100,000 goal that much sooner. Most brokerages and trading platforms provide a way for you to enable DRIP, that's the dividend reinvestment plan, inside of your account. Now for me, I always have this enabled so that I can take advantage of automatically growing my investments faster without doing any extra effort. And if you're not sure how to activate it for your trading account, just give your brokerage a quick call and they should be able to walk you through the steps in under a minute. And trust me, spending 1 minute to do this can save you 9 years, and I just showed you how. Now let's find out what happens to the end result if we start contributing $100 every month. So for the annual contribution, that $100 every month will be a total of $1,200. And here we could see that with an annual contribution of $1,200 or $100 per month, it would take 11 years for the ending balance to reach $100,406. Well, now let's take a look at what happens when I add that annual contribution of only $100 per month. I kept everything else the same, except now you can see in this table where I've added the $1,200. And the end result is it only takes me 11 years to reach that $100,000 balance. And now if we change our annual contribution to $1,993, or basically $166 per month, how would that affect the length of time required to reach $100,000? And here we can see that with that annual contribution increased to $1,993, it would take 10 years for our ending balance to reach $100,000, and specifically $100,008. So in this new example, I increased my annual contribution to $1,993 a year, which works out to $166.08 per month, so roughly $167 per month. And by doing that, I was able to shorten the amount of time required for me to reach my goal of $100,000 and reduce it down to 10 years. So I was able to save a year of time by adding roughly $67 per month as my contribution. So in this video, I was able to share with you a plan that I have to take $10,000 and 10 times it to $100,000 using the ETF known as SCHD. So I'm going to use the Schwab US Dividend Equity ETF to get to my goal of $100,000 or more. What are you going to use? And just as a quick reminder, it's not too late to subscribe to my free newsletter before I start to charge a fee. So sign up today for free by visiting stockhacker.com. Don't miss out on this opportunity. I'm sharing the stocks that I'm watching, trading ideas, and investment strategies. Plus, you can get access to my one-button stock screener. It's the one tool I use to help me pick winning stocks. And with my newsletter, you can also get access to my 1-minute financial review checklist. It's the cheat code I use to review the financial health of a company before I invest in it. So sign up today for free by visiting stockhacker.com.